So continuing our Why Ken Fisher Hates Annuity series, what we're looking at here now, folks, is we've talked about the variable annuity, we've gone over the immediate annuity, we've talked about the fixed annuity, right? Well, now we're going to talk about a product that you're likely to be shown, and when you sit down and talk to somebody about retirement today, a financial advisor or an insurance agent as well. And this product is called a fixed index annuity. And really what happened is the insurance company said, okay, look, let's take the benefits and safety of a straight fixed annuity. Let's create an indexing component and try to get growth like we could in a variable annuity, but without all the fees, all right? And let's create a product where if the client wanted to get an annuity stream of payments for life, they could do so without having to sacrifice their principal forever and give the money to the insurance company and give it over and have what's called an exit strategy, meaning if they want to get out at some point in time in the future, they could and get out with some of the money that they've got left in the contract. So hence the name fixed index annuity, all right? So we'll break this down into three components and try to make it easy to understand. So the fixed part works like this. You're typically guaranteed a minimum 1% rate of return on 80% of the money in your account. So if you put in $100,000, you're guaranteed to get a 1% return on $80,000. It comes out mathematically to be about a 0.8% using simple math, guaranteed rate of return. So let's assume that you had a 10-year term with this annuity. The worst case you could have is your money growing for a rate of 0.8% compounding over a 10-year period. And that's called minimum surrender value, by the way, all right? I've been in the industry for a long time in financial services. I've not seen any fixed index annuity or fixed annuity, for that matter, have to pay out the minimum guaranteed rate of return. I'm not saying it couldn't happen. I've not seen it. But to that end, that's the fixed component of this program in one capacity, meaning there's a minimum stated rate of return that you can get. Now, the growth component is based on the index. And so there's a bunch of indexes that you can use to grow the money. There's the S&P 500. There's the NASDAQ. There's the Dow Jones. PIMCO has indexes. CIBC Bank has indexes. I mean, there's so many of these different indices out there now. But the bottom line is they all, and not all of them, but most of them plug into a fixed index annuity somehow. And that's the growth mechanism in the fixed index annuity, right? Because obviously we're not buying a fixed index annuity to make 0.8% per year for 10 years. That's not what we want. We want more than that, right? So what happens here is they usually deploy some type of indexing strategy, and it works like this. Let's say the index that we choose has a long-term average growth rate of somewhere between 5 and 7% per year, okay? Whether it's the S&P 500, the Balanced Asset 5 Index, it could be the Budbee Index, but again, there's the Mosaic Index, there's a whole bunch of these indexes out there that it could be, and this is for illustration purposes. Let's assume our index has a long-term growth rate of 5 to 7%. Well, what happens is we're given protection periods, all right? And protection period number one starts the day we put our money in this account, all right? So we have, and let's just use a 2-year strategy in this case here. So we've got 2-year protection periods, all right? So each protection period is 2 years. And again, the protection period number one starts day one. So the first day we put money in this account, we cannot go backwards. If stock market crashes, we can't go backwards. If rates spike, we can't go backwards. The only way we can go backwards in this account is we take money out of the account. That's it, all right? So the way these work is, let's just say our index averages 5 to 7% returns. We'll use 6% for simple math, kind of middle of the road number here. And let's say for the first 2 years, our account increases from, say, $100,000. It goes up 12%. I'm going to use simple math here because I can't do compounding in my head, folks. I'm good, but not that good. So we go up by $12,000, and we're sitting here at $112,000 at the end of a 2-year period, all right? Once we get to the end of that first protection period, that 2-year protection period, whatever value in our account we have is now a protected value. And it's just the same, the original money that we put in the account's protected. Well, now our original money plus our interest is a protected value. And the only way that 112 value can go down is if you ever spend the money down, all right? So let's say the next 2 years, the index goes down 2 years negative in a row. So we're minus 6%, for instance, minus 6%. Well, what happens here is your account goes down by 0%. You don't lose any money at all. And when I talk about this, so many people get so confused. They're like, Ryan, that sounds too good to be true. What's going on? And I'll get to that in just a minute, all right? But the bottom line here is in this scenario, you don't lose any money at all. You stay flat, and we start the next 2-year protection period, and we go up, say, 6%, 6%. Please disregard my sloppy handwriting there. And so what would happen here is your 112 value would increase, we'll call it by $13,000 with compounding now. So we're at, what is that, $125,000. And again, the only way that value can go down is if you spend the money down, all right? So next thing we do here is the index goes down for 2 years in a row. Again, you don't lose any money. Index goes up for 2 more years in a row. You would go up by whatever the percentage was in the gain of that index in that 2-year period. So people go, well, Ryan, how does this work? I mean, I don't understand how I'm making money when the market goes up and not losing money when the market goes down. All right. Well, folks, I go a little bit deeper into this stuff than a lot of people do. This is a great explanation of how this program works. What's happening is when you buy one of these programs, the insurance company you're putting your money with goes out and buys bonds with your money. And they're going to hold those bonds to maturity. All right. And let's just assume for easy math purposes that they're able to maintain a 6% interest rate on their bond portfolio, okay? Well, they're going to take 3% of that bond interest and they're going to keep that for their profit, for example, all right? The other 3%, they're going to invest on your behalf in a stock market index in an effort to grow the money exponentially larger than the 3%. So what they do is they have the index here, right? And we take that 3% and we buy into the index right here, okay? If that index goes up in value, our account goes up in value, all right? So next year, those bonds, guess what? They pay interest every single year. So the insurance company says, hey, you've got a choice. We can pay you the fixed interest, by the way, and you can have that. Or we can invest the fixed interest into the index on your behalf, trying to make it more than 3%. Well, let's say in year 2, we opt to go into the index, all right? So we go to the index and the index falls, okay? Well, our account is going to flatline that year and stay the same. And folks, the reason why that is the only thing that is being put at risk each year is the bond interest paid from the insurance company's bond portfolio. It's not your principal or prior year gains. It's only that bond interest. So next year, the bonds pay interest again. Now we buy into the index at this level. If the index goes up, our account goes up. And so you get a stair-stepping effect over time. And again, next year, if we buy into the index right here and the index goes down, our account doesn't go down because the only thing being put at risk each year is the bond interest. So that's the mechanism behind how these things work, all right? Now, the thing we got to understand here is, hey, what's the limitations on this stuff, right? Because there are limitations on these programs. And so limitations come in the form of a time commitment on your money. So for instance, to get this program with this 2-year strategy, you got to commit your money for a period of 10 years. And when people see that, they always say, well, wait a minute, does that mean my money's locked up? And the answer is no, it does not mean your money's locked up. However, there's a couple of important things to understand. So what it means is for a period of 10 years, excluding year 1, okay, you have access in years 2 through 10 to 10% of your account value anytime you need it. And see, folks, the thing about this product is it was built for retirees in mind, and you can't take somebody's money who needs income out of their investments and put it into a product that doesn't offer them access to their money. It doesn't work that way. So you have access to 10% of your account value per year, okay? If you take out more than 10% in a year's time, though, they're going to charge you a penalty, and they call it a surrender charge, all right? So surrender charges work like this. You got 9%, 8, 7, 6, 5, 4, 3, 2, 1, and 0 at the end of the 10th year. And so we call this a declining surrender charge schedule. So what that means is anytime you take out more than 10% in a 12-month period, the amount you take out over 10%, they're going to hit you with a penalty, okay? So for example, if you've got $100,000 in this account and you say, hey, I've got to have 20% out of this account, okay? Here's what happens. The first 10% comes out of the account, no fee, no charge. Now I ask you, why is that? And the answer is because you have access to 10% of your account value every single year. Well, that's why it comes out no fee, no charge. But in this scenario, we're taking out more than 10%, right? So we got our first $10,000 out, no fee, no charge. Our second 10% or $10,000, they would apply let's say we do it here, year 3, for instance, they would apply an 8% charge to that money. So they would give you a check, no mistake about it, for $20,000, but they would deduct an additional $800 in fees out of or surrender charges out of your account for taking out more than 10% in a 12-month time. So a lot of people that don't like these programs, like Ken Fisher, by the way, want you to think that you pay a charge on the entire account balance if you exceed 10%. That is true if you take all the money out at one time, all right? But if you exceed it by 10% one year, you take a withdrawal of 10%, you need another 10% a year. That's how the surrender charge schedule is going to impact you. And it's not as bad as you think, but here's the way you look at this, folks. Don't ever put so much of your money into one of these products that you would have a liquidity issue. Make sure you have ample resources outside of these types of programs in your retirement accounts to where you would never have to take a surrender charge in the first place or take out more than 10% in a 12-month period. And great planning and great financial advisors can see to it that you don't have to do that unless some extreme circumstance happens, all right? So far, we've covered the growth mechanism, okay? Kind of how that works. We've covered surrender charges. Let's go into the annuity part here for a second, because the annuity part here is the guaranteed lifetime income, if you will, all right? So there's some products out there right now that are guaranteeing 7% per year, which basically means if you put in $100,000, you're guaranteed a 7% return, and your money should grow, and I'm using just simple math here, folks, okay? Your money should grow to about $200,000, all right, over a 10-year period. Well, let's assume that the $100,000 you put in the index portion grew to $150,000, okay? So you get to the end of the 10-year period of your program. You don't have to wait 10 years to activate income in most cases, but in this situation you do. And you want to go here to this annuity payment. You say, Ryan, I see $200,000 here. I see my account value is $150. What are my options? You have two. You can take this $150 out and go anywhere you want to go to invest those dollars, all right? Or you can come over here to the guaranteed income. And you go, well, Ryan, how much could I get off that guaranteed income? Well, it would depend on your age, all right? And they were going to assign you a payout factor based on your age and whether you want a joint life payout to pay you and your spouse or a single life payout to pay just you. I want to use 5% in our analogy here, just an arbitrary number here for illustration purposes. And so we got $200,000 times 5%. What that means is our guaranteed income check from this portion of our funds would be $10,000 a year as long as we have breath in our body, okay? Now, what happens here is the $10,000 a year begins being deducted off our account value, okay? So we have interest from the index going into our account, and we have that distribution going out. So if this account balance drops to zero over a period of time, they still have to pay you $10,000 a year for the rest of your life. If you decide in 5 years you want to take any residual balance out of this, you can take what's here and go invest it somewhere else if you want to. If you die anywhere during the surrender charge period, or you die while you're taking income, any remaining balance to this account goes to your beneficiaries, no fees, no charges, no questions asked. So that's how these things can provide guaranteed income. So fixed index annuity, right, can be pretty complicated. When you break it down in simplest forms and kind of dissect it a little bit, it gets a little bit easier to understand. Now, thus far, when we look at a straight fixed index annuity, usually the fixed index part does not have a fee on it. When you start adding the annuity benefits of the guaranteed income for life, the income riders and that sort of thing, that's where fees come into play. But even though fees come into play here, fees normally in a fixed index annuity do not exceed 1% in most cases. So folks, that's our short series on why Ken Fisher hates annuities. I hope that we've given you some very general education on these things. Feel free to hit the like button down below, hit the subscribe button. We put out great content on the channel all the time. And if you got some comments down here, that you've got some questions on anything I set up here, you want me to re-clarify something, write it down here in the comments and we'll absolutely reply. All right. So thanks so much for tuning in to the On the Money YouTube channel powered by Allied Wealth. Once again, give us a like down below, hit the subscribe button, and we'll keep posting new content. You'll get alerts when we do. Thanks so much.